In news related to economy and finance, we hear that there is an inverse relationship between price and yield. So let us dwell into this concept to know more about it. The fact is that there is an inverse relationship between the bond price and yield. So when there is an inverse relationship, we know we need to find out what is the cause and what is the effect. So the cause is the yield. Means yield affects the price, it's not the other way around. Price doesn't affect yield, yield affects the price. And yield errors or indicates market expectations of return. Now this is more of a fact of this concept. And now let me explain this with an example. Say for example, company A issued a bond with face value of 100 carrying a coupon rate of 7% in December 2024. Due to market expectation, coupon provided on similar type of bond increased to 8% in May 2025. आपने उस पर्टिकुलर बॉन्ड में इन्वेस्ट किया होगा नवंबर दिसंबर 24 में 7% कूपन आपको मिल रहा है, बट अभी उसी कंपनी ने या सिमिलर टाइप को कंपनी ने सिमिलर टाइप ऑफ बॉन्ड इशू किए विच कैरिंग द सेम क्रेडिट रिस्क, वो 8% आपको कूपन प्रोवाइड कर रहे हैं. तो व्हाट एज एन इन्वेस्टर वुड यू वांट? आप ये चाहेंगे कि जो एग्जिस्टिंग बॉन्ड है यू विल सेल इट एंड आप जो नए बॉन्ड इशू हैं वो उसको एक्वायर करेंगे सो दैट यू विल गेन मोर इंटरेस्ट रेट, मोर कूपन रेट. इंस्टेड ऑफ 7% यू विल गेट 8% rate of coupon. So this is how this market expectations have changed over a period of time. But you know, when you try to sell it, markets are also efficient. They will not accept the 7% bond at this price of 100. They will buy it at such a rate that yields matches with the existing rate of 8%. Then they will adjust the market price. वो भी उसको 100 रुपये में नहीं लेंगे, वो उसको एक कम रेट पे लेंगे so that they match the coupon with the market price. So यहाँ पे आपको 7% का कूपन मार्केट प्राइस कैसे एडजस्ट होके 100 की जगह यू विल ओनली गेट 87.5 इन सेकेंडरी मार्केट. मीन्स देर इज a valuation loss of say 100 minus 87.5, that is 12.5 rupees. And why this loss happened? This loss happened because there was a yield movement from 7 to up percent. So now you know when yield moves up, price will go down and which will result in a valuation loss. So the overall crux of this fact concept series is upward movement in yield results in price of the financial asset to go downward, thereby resulting in valuation loss, also known as mark to market loss. This is what is called interest rate risk, which is a type of market risk. Now on the other way around, when yield moves down, price will go up, which is not a risk as such, but because of the inverse relation, you will gain in it. So that's not a risk as such because you will gain in it. Risk is only there when there is a potential losses. So only when there is an upward movement in yield, you will lose something. This is the formula for market price. If you want to know that how the price of 87.5 is derived instead of 100, this is more of a market driven approach. Let us understand the bond price and yield through a curve. Now this is the y-axis, which is dependent variable. This is x-axis, that is independent. So yield is independent and market price is dependent on this yield. So because of this yield, you know, if yield was this, so price was at this level. Now since the yield went up, the price went down. So that's how this is depicted through graphics. Hope this concept is clear. Thanks.